welcome to the Getting Sharp podcast presented by Omega Point. Hi, everyone. I'm Omer Cedar, CEO and co-founder of Omega Point. And for those of you who've tuned in for the first time to this podcast, we've created it to really help our investor community quickly understand some of the most relevant topics impacting institutional investors in the current market environment. Today, I'm joined by Hallie Martin of Wolfe Research to dive into insights into the market from really a data-driven lens and really focusing on effects of the last few weeks. I think many investors probably found that their vacations may have been disrupted by the Bank of Japan's announcement to raise interest rates, negative surprise from the job market. So now that their vacations are disrupted, they're probably having to spend their time trying to understand what the knock-on effects are, how to analyze what happened in the market, of course, and really understand between now and maybe the next Fed meeting or the election, what should we be thinking about? So to really help our investor community make sense of all this information, Hallie and I, will be breaking down investor reactions and really the analysis really across the board onto these announcements using Wolfe's quantitative factor lens. So I'm very excited. That really formally would like to introduce Hallie Martin from Wolfe Research. And Hallie, thank you so much for joining me today.
Thank you, Omer, for having me. Wolfe Research has been working closely with Omega Point now for close to 7 or 8 years. I'm very excited to be here today to speak with you all. Just by way of introduction, my name is Hallie Martin. I run the QES Risk Solutions business within Wolfe Research. The QES team, its bread and butter for several decades has been systematic equity strategies to capture quant alpha. But over the past decade or so, we focused much more on risk management. We built our own risk funnel engine to improve upon the portfolio construction outcomes for our investable alpha strategies, and also to be more intuitive to fundamental managers. And so we use non-conventional factors alongside conventional factors in a lot of our risk models. And some of the most popular factors are macro sensitivities and investor positioning signals, which of course are quite relevant in today's market environment. We also have a suite of sector risk models for specialists. And so we find that those really resonate with portfolio managers when looking at their portfolio through the sector lens.
Wonderful. Now, there's the complete set of really lenses that I think we found quite helpful to the investor community and working with them over the years. And so that's great kind of segue to talk about, what you're seeing across some of those lenses and really give us sort of a sense for what have you been looking at, what investors should be paying attention to when it comes to some of these last few weeks and certainly in the more recent week, in particular, maybe even in, Monday.
Yes. Well, this definitely has not been a quiet summer. We've definitely seen, significant factor volatility, a big pickup in factor volatility, looking at the landscape, both in terms of what happened, Monday and last Friday and, mid-July after Biden dropped out of the presidential election. The quarter's been pretty exciting. And actually, quarter to date, the worst performing factor in our U.S. Broad equity risk model is our interest rate factor. And so that's down about 2.5% quarter to date. It's had, big move and about investor kind of rotations that go alongside these macro moves. The other factors, of course, that have, not done well this quarter include size and volatility. And actually, most risk factors have been negative. So one big exception would be dividend yields and to a lesser extent, leverage. But by and large, most of the conventional factors have actually had negative returns quarter to date. And I would say, in terms of this week, we obviously saw, a massive rotation on Monday. Some of that kind of reverted towards the end of the week. But I think what was most sort of interesting from a factor perspective is it was classic risk off in many ways. So the volatility factor and book to market, were down. And on the upside, we saw a flight to quality in terms of ROE and also momentum factors. We also saw a pickup in sensitivity to inflation, to oil prices, and to interest rates, as well as people began to kind of reprice the macroeconomic kind of expectations for the Fed's path on cutting rates.
No, it's very helpful. It really does sound like there, from a broad market perspective, right? There's some kind of more medium-term trends that have been taking shape ahead of Monday, and then of course we saw a very sizable risk off with some certainly some reversion on that later in the week. What's also interesting and what continuously is interesting when we pull apart some of the sector-oriented views that you have from the sector models and some of the things that we've been doing work on at Omega Point, which we call, kind of a surprise metric, but really ultimately looking at relative to what your model predicts, right? How does the factor move? And on the sector side, I saw some really interesting, moves on Monday in particular. Some of those did have some reversion afterwards, but if we looked at your energy model, we saw things like, debt to EBITDA, EBITDA to EV, and even profitability have multi-standard deviation moves to the negative side. And we actually saw, which was also interesting, kind of looking at the positive side, kind of when we looked at healthcare, at some of the consumer model that you have, gross margins, inventory turnover, the financials, return on assets factor went up. So really some interesting moves by fundamentally focused factors, right? Historically, we know size and volatility tend to move a lot because they're very volatile factors. But it's interesting for the sector-oriented PMs how these fundamental factors did have multi-standard deviation moves as well. Is that something that you've seen kind of historically kind of play out? And certainly would love your feedback and thoughts around those moves.
Yeah, and I think this is also a good point to put into context. When we talk about how the broad macro environment and interest rates, impact equity portfolios, it obviously does so across a number of dimensions. So one, what's the overall kind of level of the equity market? Where is it going? And then within that, what do these factor rotations look like? And we put an interest rate factor into our risk model, and actually, that factor is down very much in line with expectations. The 10-year yield on U.S. Treasuries has dropped from about 4.5% at the beginning of the quarter to just under 4% today. And so with that 50 basis point or so drop in the 10-year, we would have expected that interest rate factor in our equity risk model to be down about 2.5%. And indeed, it's down just over 2.5%. But there are implications for other factors. And so obviously, what's happening in the macro environment is going to have implications for things like value and growth and these more fundamentally oriented factors. The power of the sector models is we are often swapping out, signals that might be used in a broad equity market model for something that is more intuitive to managers in the space. And so this is, somewhere where someone who's focused on retail, for example, is probably going to be looking quite closely at gross margins. And so by having that factor in the model and seeing kind of the significant move that it had on Monday, the sector specialist is going to, have more insight into how this is actually impacting the dynamics of its portfolio, within the consumer space.
Yeah, I mean, most definitely. I mean, it really very kind of powerful to look across multiple sector models at the same time, whether it's TMT, healthcare, industrials, just to see, sometimes when you kind of take a look across the board, you're starting to see really get a thematic picture of what is really investors care about, whether they are pure healthcare investors or financials investors or whatnot. There's definitely was on Monday, definitely a flight to quality aspect, and it was played out in the fundamentals that normally kind of in a more cross-sectional view, right, it would be harder to see sometimes because you're having to kind of have more of a broader picture. So that's certainly very interesting. And from my perspective, really, investors I've digested a lot of this information. Obviously, again, working through the fact that there's a Fed announcement, a Fed meeting in early September, and of course, election downfield. How are you thinking about what investors should be focused on and what should, without really being, we're not necessarily making predictions, but really kind of looking ahead and what should investors be tracking and thinking about in their portfolios?
Right. Well, obviously we expect that there's going to be a significant amount of news flow in the coming weeks and coming months, whether that is Fed guidance, macroeconomic releases, results, new polling results about the US presidential elections, geopolitical news flow. There's definitely a lot going on in the world today. We do have a suite of tools that we look at to help investors think about more or less factor timing. But I think one of the more important things is looking at exposures in the portfolio and understanding whether or not those systematic exposures are actually consistent with your investment view, or whether they're just somewhat arbitrary exposures, based on the names and the position sizes in the portfolio. Obviously, if you're taking a risk that's aligned with your investment view, that's a good thing, and you're hoping to see a return commensurate with that risk. However, if you have a large exposure and it's not part of your investment view, that's a point where it could definitely cause elevated P&L volatility that might not be favorable. So when we look across some of these tools, what we can see is based on the recent moves that, accelerated to some extent this week, we definitely see our interest rate factor and our volatility factor, which is really a risk on, risk off kind of sentiment factor, stretched significantly to the downside. So if we look at where those factors are relative to 20-day moving averages, 50-day moving averages, they're more than 2 standard deviations kind of stretched to the downside. Now, this does mean, because factors are mean reverting, that perhaps there is an elevated risk of mean reversion and those factors kind of bouncing. However, while factors do tend to be mean reverting, over time, we do find situations where the regime is shifting. And so, potentially technical analysis isn't the only tool in the toolkit that's going to be helpful. If we look at our style factor rotation models, which are really more a suite of systematic rotation models of different varieties, we also see a lot of uncertainty around the volatility and the interest rate factors in particular, as well as the size factor. And so here, we have an economic cycle model, we have a machine learning model, a tactical regression model, a cross-sectional model. We run all of these models on these style factors to decide whether or not we have a positive or a negative outlook on these factors in both the short term and the medium term horizon. And where I would say these models do have positive conviction is actually around momentum. So these models are uniformly positive on momentum in both the short term and the medium term, but there's a significant amount of uncertainty across the models. They're all saying different things when it comes to size and when it comes to volatility and when it comes to interest rates. So this is a place where, if you have a market view, perhaps you want to be taking risk that's aligned with that view. But if you don't, you might want to be thinking about managing those exposures in your portfolio.
That's actually a very powerful way of looking at it. Most systematic quant models are resident within our investor community, but the fact that you actually have sort of kind of forward-looking models that are helpful, and you can actually project them on these factors to just get a sense for, is there agreement or disagreement? Sounds like really agreement on one factor. Maybe people are going to be pretty happy about that if they're invested in the higher momentum names that have had a pretty big pullback. That could be really interesting. But it sounds like, and some of these other factors, the fact that there's a lot of disagreement relative to history is going to be a challenge, right, for investors to sort of incorporate. And it sounds like your suggestion is, unless you really believe in these factors, find a way to hedge them out. And again, of course, our community understands there's many tools out there, including obviously working with Omega Point. If you want to hedge out these factors, there's definitely different ways of doing that, either individually or collectively, right? If you're interested in kind of a multi-factor hedge with that. So hopefully, this is our intention is to kind of make this punchy and useful for the investor without spending a lot of time. But definitely, if you want to dig in further, talk to Hallie and I and get into the details with us. We'd love to do so. And have you sort of dig into your portfolio. Really enjoyed the time that I spent with you, Hallie, today. This is always a pleasure to spend, and hopefully you'll be able to get some vacation time before we come back for Labor Day.
Definitely. And thank you so much for having me today, Omer. This is definitely my first podcast. Very exciting.